Welcome to my market commentary for the first quarter of 2022, and what an incredible amount of change has happened in just 3 months. We will be talking about the new invasion, oil prices, massive changes in the yield curve, and of course, the Federal Reserve once again. Let's get into it. I'm Joe Macek, Portfolio Manager and Investment Advisor for IA Private Wealth, and welcome to my YouTube channel, Investing Made Simple, where you can always find the most trusted information on building your net worth fast. I'm so glad you could join us today, as the amount of change in the world that has happened in the last 3 months has been absolutely mind-blowing. And I can't wait to dissect all of the little nuances and see how it will possibly impact all of us investors going forward. But as always, before we get too deep into the video, I'd like to go through my usual disclaimer. And the long and the short of it is, before you make any decisions surrounding your money based on any video you see on YouTube, please take the time to consult with a fully licensed professional, or feel free to reach out to me on a one-on-one basis. The other thing you need to do is smash that like button for the YouTube algorithm, as it really helps out my channel. And if you happen to like my content and want to be kept in the loop with all of my latest videos, I'd be thrilled if you would just hit that subscribe button, leave a positive comment in the comment section below, and darken that notification bell. When we left off in December, the Fed led us to believe that they were going to gradually raise rates. Oil was increasing, but not terribly, and there was no real geopolitical risks that took shape. But all that has changed. Soon after I posted my commentary, the Fed minutes were released and the markets went haywire, as the minutes suggested that as many as 6 to 7 rate hikes could happen, along with the rolling off of the balance sheet towards the end of 2022. This was a far more aggressive tightening policy that we were led to believe from Jerome Powell when he spoke in the December meeting. Super high inflation reports also came out, as well as the news of Russia deciding to invade Ukraine that essentially cut off Russia's oil supply through sanctions and sent oil to $120 a barrel at one point. We also started to see in late March, early April, reports of the yield curve inverting, and I can honestly say that if I could go back in time and tell my December self that parts of the yield curve would be inverted by the next time I posted this commentary, I would not have believed it. But here we are, and given the latest batch of news and the latest developments, I will at this point update my forecast for this year in hopes of delivering the trusted information you have come to know and expect from me and my channel. Okay, so for this commentary, I'm going to start off with the December Fed minutes, walk through what happened in January in the markets, then cover the invasion along with what happened to oil prices and their impacts there, then bounce back to the current rate hike, the Fed minutes just released, the current shape of the yield curve vis-a-vis December, and share my new thoughts going forward. I will admit the Fed minutes in December did catch me by surprise, as the message that was delivered by Jay Powell at the time seemed to indicate a slower, more methodical approach to raising rates and rolling off the balance sheet. I even trusted and believed the Fed that this time would be different, and had seemed to learn from their lesson in 2019. Did you hear that? I said it. I thought this time would be different.
This time is different. This time is different.
I really should have known better. You see, even the most seasoned professionals in the business like myself still get surprised now and again by things that should go a certain way and they don't. I genuinely felt the Fed this time around would take a more prudent approach in tightening, even in the face of massive inflation numbers that I still think are transitory and are being caused largely by supply chain issues and things other than full employment pressures. Nope. Just as I was starting to trust the Fed would do what I felt was the right thing, I was chatting with a colleague of mine, and I was reminded of how many times the Fed actually over-tightened and overstimulated the economy since they were created. And let me tell you, their track record for soft landings is nothing short of terrible. So how many times has the Fed actually achieved the perfect amount of tightening and stimulus since they were created? Almost none. Greenspan may have been the closest to achieving a soft landing in the early 1990s, but every other tightening cycle was either tightening too much, and every other accommodative cycle was also too accommodative. When it comes to the Fed, and specifically to hikes and stimulus, the prudent thing to do as an investor is to assume the Fed will get it wrong and over-tighten and cause recessions when they're tightening, and then provide too much stimulus and allow for too much growth when they're accommodating. That's predominantly what has happened since they have been created, and I see no reason to believe otherwise. Assuming the Fed will do the wrong thing, as they have almost always done in the past, this means that they will hike rates far higher than they should and roll off the balance sheet far more and likely far earlier than they should, and eventually invert the yield curve and cause a recession. If we are steadfast with the assumption that the only question now is not if we are going to see a Fed-induced recession, but when, the proof is now starting to manifest itself in the yield curve, as the 2-year yield briefly traded higher than the 10-year, showing an inversion on the part of the curve which we must watch closely. Further proof is in the Fed minutes, as they are now calling for the balance sheet to be rolled off as early as May, and several hikes, including a possible 50 basis point hike to take place very soon. So much for gradual. I believe this is why we have seen such a huge move in the bond market and in the yield curve in the past 3 months, and the move has been nothing short of astounding. But not all reports on yield curve inversions are created equally. In fact, even seemingly reputable sources make slight errors on the reporting on the inversions. Examples I will make in my video dedicated on the yield curve and what to watch out for. Now, if you've been watching this channel, I know in previous videos I have said my yield curve video is going to be done, and you'll be happy to know that I am producing it at the same time as this video. I cannot wait any longer to make this one, given the current shape of the yield curve and the fact that the dreaded inversion is in the news. And it's timely that we produce this video as soon as possible. So I will be writing, shooting, and editing both this one and my yield curve video at the same time, with a release soon after this commentary, and you will finally have another great video that you must watch if you want to know everything there is to know about what a wonderful indicator this has been. Now, the released December Fed minutes clearly spooked the market, as the higher risk tech names seemed to sell off in the first quarter, giving rise to a severe correction in the Nasdaq. With that said, many REITs, banks, and oils were not greatly affected or went up in this time frame, as the higher inflation numbers seemed to be a positive for those sectors. And while I did say I had positions in some businesses related to oil, and I believed oil was headed higher, likely past $100, the Russian invasion of Ukraine and the resurrection of the long-lost geopolitical risk in the world came back into markets and pushed oil to new highs as Russian supplies were sanctioned. Currently, the oil markets cannot afford to lose Russian oil production, as OPEC Plus has made it extremely clear that they are not going to increase production any more than the slated increases they have talked about in the past. To further add upward pressure to oil, currently airlines are only using about 1 to 2 million barrels a day for jet fuel, which is substantially lower than pre-pandemic levels of approximately 6 to 8 million barrels per day. Should airline travel come back to those levels, you will see a further drawdown in inventories and further upward pressure on prices. Now, there is some relief, as the US is releasing 1 million barrels a day out of strategic reserves to help lower the price of energy short term, but this is widely viewed as a very short-term band-aid measure and cannot be sustained for a long period of time. I would also think that the US would want to replenish this reserve at some point, so this is very likely kicking the oil can issue down the road. So unless some serious demand destruction happens in the oil sector by way of pricing being too high and we don't want to pay for it, or we have a recession, or sanctions on Russian exports are miraculously lifted, or some other hardcore drilling programs are put into place, I believe high oil prices are here to stay for 2022 and possibly into 2023. This does not bode well for the markets, as 70% of the GDP of the US is the consumer, and the consumer is considerably weakened with high energy costs, as they have less money for that consumption that keeps the economy rolling. Now let's wrap up this quarter's commentary with a little more commentary on the new Fed hike that happened, the latest minutes, and the current shape of the yield curve, as well as a new developing issue that I think we have to keep our eye on. A number of analysts thought the Fed would move more aggressively in the March meeting to raise interest rates by 50 basis points instead of the 25 basis points they did. Personally, I'm very glad to see that they didn't, as they may have sent the wrong message to the markets, and I think more communication would have been needed to enact such an aggressive move. Something that really needs to be noted about interest rates and monetary policy here, which I find quite alarming, is there has been a lot of very smart people that have been on record over the years to say that the Fed's tools to help stave off recession in terms of interest rate cuts and balance sheet expansion are losing their power. Interest rate cuts and balance sheet expansion are becoming more and more ineffective when it comes to being able to support the economy and markets. The Fed is being forced to use larger and larger amounts of money in stimulus when bad things happen. Many have described the Fed's power to jumpstart the economy over the past 15 to 20 years akin to pushing on a string. Here are some very interesting things to note. The Fed has only barely begun to tighten. They have only raised by 25 basis points, and the balance sheet has not yet started to roll off. Yet the yield curve from December to today, as shown earlier, has flattened considerably and parts of it have inverted. The bond market is very seldom wrong when it comes to forecasting trouble on the horizon, and the bond markets are considerably larger than the stock markets. So if you want to gauge the health of the economy and the stock markets, the bond markets usually tell you everything that you need to know. Right now, I believe the bond markets are telling the Fed that their current track is far too aggressive, and their current rate hike trajectory will cause a recession. With that said, the Fed has made it very clear that they will do whatever it takes to ensure inflation is tamed, and if that means raising rates to quash inflation, then that's exactly what they will do. A number of very smart market participants believe, along with myself, that the Fed is in a no-win scenario. Raise rates to kill inflation, you risk a severe recession. Don't raise rates enough, you risk inflation continuing to rise and being a massive problem later. Many believe it's very unlikely that the Fed will achieve a soft landing, including myself. Over the next few months, I will be meeting with clients to reevaluate their personal circumstances and provide tailored advice as to how they want to approach the next 12 to 18 months, given this new information, and act accordingly. Of course, every client is different, and we aim to ensure that we give the best advice we can with the best available information out there so that they can make the proper decisions. We take into account everything: their objectives, risk tolerance, age, and personal goals they set out to do. If you're watching and would like to have a fresh look at what you have and what you're doing in the markets, I would invite you to reach out to me for a more one-on-one approach. Once again, I want to thank you for joining me here at Investing Made Simple. Please hit that like button for the YouTube algorithm, as it really helps out my channel. And if you like my content and you want to be kept in the loop with all of my latest videos, I'd be thrilled if you would just hit that subscribe button, leave a positive comment in the comments section below, and darken that notification bell. Until next time, this is Joe Macek for Investing Made Simple. See you soon.